So we are live. So yes, now you can go in now and do it. We'll wait for some people to come on board and get started. And we will go. So you see where it says watch together, start. Just click that and you will start a party. Okay. What's going on, Mr. Maxwell, Rosa? What's happening?
Not much, my friend, not much in this post-COVID age that we're living in. Oh, well, COVID age, not even post. We ain't there yet.
Yeah, I know. In the popo age, you go in the Rona age.
In the COVID Corona age, yes.
Exactly. So welcome everybody. I am here with Maxwell Rosa. He is a mortgage broker with Popular Bank here based in New York, but he can do mortgages all over the country. Is that correct? Correct me if I'm wrong. Today, the purpose of this conversation is to talk about the mortgage industry, what's happening right now, what's happening with refis, what's happening with mortgages today, what you can do with your particular mortgage, and then kind of give you guys an outlook on the future of what's going to happen. This is my first Lunch and Learn, which will happen weekly, where I will be bringing you information regarding the real estate market here in New York and around the world and what's going on. So first things first, Max, give everybody your background and where you're from, what you're doing, and how long you've been in the business.
Okay. Born and raised in New York. Been in the business for about 17 years. Now I'm mostly with Citibank, and now I'm with Popular Bank in the New York City area, the 5 boroughs. Grew up in New York City, so I'm a native New Yorker.
Okay. All right. So let's just jump into it, because I know a lot of people want to know, is this the right time for refis? When people see interest rates going down, or does that normally necessarily mean that it is the best time for them to refi? That's right. One.
So everybody, each person is individual, right? So everybody has their own need. So at times, certain clients might not need to refinance, or their rate is low. There's no need to refinance for that client at this time. But right now, the rates are historically low.
Okay.
We're locking clients at 3.25%, 3.375 on 30-year fixed mortgages, which haven't been seen in years. So right now, we're at the lowest we've been.
Okay. What is going on in the mortgage industry? What you think post COVID-19 world that we're in?
Yeah, I mean, the mortgage industry right now is tight, and that's the word I'm going to use. Guidelines are getting very, very strict. Where 4 months ago, somebody with a low FICO score could easily go through the mortgage system and close within 2 months or 45 days. Now it's getting a little tighter. Guidelines are getting restricted. If you wanted to refinance and cash out a lot of money, that's a little hard right now. Most banks are getting away from cash out refinances on, hypothetically like an investment property or something like that. They don't want to do those anymore. Let's take Chase, for example. Chase, at this moment, Chase is just doing 700 FICO and 20% down. So
700 FICO, when people normally would have been able to get a mortgage around a 650 score, correct?
650, 640, absolutely. Where Chase now, you have to have a 700 FICO score and 20% down.
Okay.
So that's just one example. I believe FHA has changed their guidelines with higher credit scores, lower debt to income ratios. Things are just tightening up across the board. And what are the reasons for that, right? Why are things tightening up? Yes, the coronavirus, the pandemic is going on, but you have to remember it's all about risk, right? So now unemployment is going to skyrocket, and it has skyrocketed. Okay?
Right.
So the bank looks at it. This is how banks look at risk. We're lending you 80% of your home. So let's take $1 million loan amount. So when
you speak of that, you really are speaking toward New York, because across America, a lot of people are not putting 80% down. A lot of people are putting 10% down. A lot of people are putting 15% down. So that really is the big difference.
Right. Well, I'm going to be speaking about New York. But what happens is when you change guidelines, it goes across, right? It's not okay, these are the guidelines for New York. The bank will change guidelines across the United States, across the whole program. Okay. So let's just take, a condo in New York for $1 million.
Right.
Client would put down 20%, go through the mortgage process. Okay. What underwriters are doing now is, okay, you put your 20% down. What's your credit score? Okay, my credit score is 720 or 700. Okay, well, for a jumbo mortgage, you need 710. Now I need an exception. Usually, it would be easy to get an exception of that, 10 credit score difference. It's kind of an easy exception. Now it's a lot harder. It's all about risk. The bank is giving 80% of the value of the apartment.
Yeah.
You're putting down 20. 80% is a lot right now at this, COVID world that we're living in, right? Also, the forbearance. The government came out and says, okay, we're waiving your payments for 90 days. Okay. Right. Nobody really knew when the government came out and says, okay, you're allowed to forbear your mortgage payments for 90 days. Nobody knew whether, number one, is are the credit agencies going to hit you with a late payment?
Right.
Nobody was talking about that. So, yes, you're forbearing the loan, but you're not paying it.
Right.
So we have to find out, well, is TransUnion, Equifax, Experian, are they going to hit you with a late payment? Number two, is the bank going to request all that money on the fourth month?
Right.
So it goes your first 30 days, second 30 days, 90 days. Now we're in 90 days. Now we're in 120 days. Do I have to make 4 months of payment in 1 month?
Mm-hmm.
Fannie and Freddie just came out, I think, last week and said, now Fannie and Freddie obviously are the two mortgage industries that buy mortgages. Okay, they're the financial industries that buy mortgages from the banks. They just came out and said that the banks will have to work with each client individually and say, can you pay this back or put you on a payment plan? Okay. Thank God. So that eliminates number two. So those are questions that we were having on, yes, the government says you forbear your payments for 90 days. Mm-hmm. What happens? So now you have mortgage banks and you have banks in general that clients are not going to pay their mortgages for 90 days.
Right.
That's a lot.
That's a lot. That's a lot of people with no. That's a lot of banks with no money, and they're already spending cash.
Exactly. Mm-hmm. So think about how many mortgages like a Wells Fargo has, or a Chase has, or Citibank has. We're talking about billions, mm-hmm. Billions, not millions, billions. And if 30% or 15% or 20% stop making their payment, that's a lot. That's a lot of money not coming into the bank. Right. So forbearance, mm-hmm. Coronavirus, people losing their jobs. What happens? The mortgage industry starts to tighten. Okay. I'm not saying it's impossible to get a mortgage. It's just going to take a little bit longer than normal. Where clients used to close within 30 to 45 days, you're looking at 60 to 75 days. And it's going to be a little, strenuous to get that mortgage. If you remember, Charlie, you definitely remember this, 2008, 2009, when the crash happened, banks started to tighten up. And as they tightened up, guidelines got stricter and stricter and stricter. Now, since 2008, 2009, we've loosened them up, but coronavirus came in and strengthened everything up again. So that's what's happening right now with the banks.
Okay. Do you think rates will go lower than what they are now?
It's everybody asks me that question. I probably it's a daily question that I've been asked. I don't know. I really don't know. We dropped down in my bank. I think at one time we dropped down to 2.875 on a 30-year fixed for a conforming loan, which is insane. So basically, if your loan was under 500, and I think loan limits from conforming is 530 or 520. So let's say your loan was 500,000, and I believe for 3 days of that 1 week was 2.875 on a 30-year fixed. That was
2.875.
Yeah, at that time. So that was I think it was the first week of March or second week of March. Okay. And it was only there for 3 days. It literally was only there for 3 days. Then the market shot back up again.
Right. Does the stock market have a reverse effect, an inverse effect on the price of what is being set?
Yeah, I'm glad I'm going to dissect that, what you just said. So everybody hears that, we're dropping the rate, the Fed is dropping the rate. That has nothing to do with mortgage rates. And I'm going to say that again for all your viewers. When the Fed drops the rate, it has nothing to do with the mortgage rates. Mortgage rates are based on mortgage-backed securities, MBSs, and the Treasury bond, the 10-year Treasury note. Okay, so when those fluctuate, that's when mortgage rates fluctuate.
Okay.
What what the Fed rate will fluctuate is if you have like a home equity line of credit,
right?
You'll see drop. If you have a CD, you'll see that change. A certificate of deposit, you'll see that. Your money market, your mutual funds, so those things will affect it.
Right.
But rates are based on something totally different.
What happens what happens when the Fed rate goes down to 0?
It's listen, it's a scary time we're living in. Really is. I think the Fed is going to keep rates very low. I believe I read something this year recently that this year it's going to stay low. Fed rate, they're not going to raise it at all this year. So they're going to keep it where it is.
Okay, cool. Let's see, we got a couple of questions, so I'm going to bring that in. All banks are not heeding to Fannie and Freddie recommendation of the 90-day forbearance. How can they be made to do so? Or is that possible across the board?
I would go to Fannie and Freddie. Make sure your loan is either Fannie or Freddie loan. If it's not, that means it's a portfolio loan. Then you would have to go by the bank's rules.
Right. So it's the type of loan you got from the bank.
Right. So it's either I'm gonna not discuss government loans. So government loans are VA and FHA. Right. So those are government loans.
Right.
So for Fannie and Freddie, it's either a Fannie Mae loan, a Freddie Mac loan, or it's a portfolio loan. So if your loan's a portfolio loan, you have to adhere to what that bank, it's their bank, that bank's regulations.
Okay.
If not, look up on Fannie's website or Freddie's website to see if your loan is a Fannie or Freddie loan.
Okay, cool. If you guys have questions out there, make sure y'all send them my way. If you got something out there that you want Max to know, Max Rosa is with Popular Bank here in New York. He does do loans all across the country. He is my go-to guy when it comes to mortgages. We probably do how many deals a year? It depends on the year, right? So
depending
on the year, but he's my bull in the china shop, as I say. Is it a good time right now to refinance your home?
Yes. I mean, even if your rate is, if you're over 4%, definitely give me a ring or call your lender and see if you can get a definitely lower rate. You should be able to refinance.
Okay. And how is the coronavirus going to impact the market value of your home? What are your thoughts on that?
Right. So historically, right, rates are low, home values are high. When the rates go higher, home values go lower. I have my own theory on this. I think home prices are going to drop a little bit, especially in the New York area. You're going to see a lot of traveling, right? I just read an article today where this family left the Upper East Side, went to the North Shore of Long Island, and she's not moving back, so she's selling her property. I think you're going to see a lot of that fluctuate. I think you're going to see a lot of people leave the city because of what's going on with coronavirus, because the 5 boroughs, especially forget about just Queens and the Bronx. That's like, the hot spots. There's Elmhurst, Queens. It's like a hot spot, and I believe the Bronx or the South Bronx is another hot spot.
Yeah.
So I think people are going to trend away from the cities, and then people are going to come in. It's just going to, but you're going to have a lot of.
I'm seeing a mixture. I'm seeing people who are getting ready to come here, a new wave of people coming in the city.
Yeah.
So it's New York. You're going to always have people come into New York, and you're going to always have people leave New York. You're going to also have people who want to stay in New York, but they're going to also want to get out of that 1-bedroom and get in a 2, or get out of the 2 and get in the 3. And then you're going to have those people who just say, you know what, I'm done and I got to leave. Then also, too, you're going to have those individuals who I think are investors who are going to say, you know what, as they say on the side, we say it on the side, and Joanne, who is part of my team, we always say, hey, break the emergency glass and, that this is the time for a lot of investors to sell. But one thing about New York City, which is interesting, New York City has so much cash.
Yes. Yes.
So the investors are going to be the first ones that's going to hit the market. Yeah. I believe that's going to be out here hitting the market, looking for deals and looking for people who are panicking to buy. Whereas sellers that don't need to buy, they're going to wait, I think, until third or fourth quarter.
Correct.
And then they will purchase. I mean, then they would move, which makes perfect sense for anybody that's really trying to do this.
What do you think of the rental market? Like, where do you see a rental market going? Do you see that? Because as you know, you and I have discussed me getting something in the city.
Right.
At one point to rent it out and where the rental, where rents are and will they increase or will they decrease or what? Where do you see that going?
Well, I think it depends. Right now, I'm getting a lot of interest from renters. The only thing we can do here in New York is show virtual tours or show through pictures. Right. And then if they want to sign a lease, then we let them get into the building. That's it. But it's going building by building. It's block by block. So that's a problem that's unique to New York. That's not, it might be in DC and some other metropolitan areas like Chicago and Philly and Baltimore and places like that. But everybody else is pretty much single family living or living in a garden style apartment or townhouse type apartment or detached single family home. So they might not have that issue, but everything is being totally different. But also too, what I'm finding, the makeup of the mindset is different. Younger people don't look at this as a problem because it's not affecting them per se as much.
18 and 44, I think the percent is less than 1% or something like that between the age of 18 and 44. So it's almost between that age group, it's almost just as bad as just a regular flu or going outside, getting hit by a car or whatever. So you take that risk, and that's why you think younger people are going to want to, go out more, and the risk for them is very low.
Exactly. And so it's a different situation. Any other questions you guys might have out there in the audience for Max? Some other questions I have, as you are seeing right now, are you seeing any, and see, this is the other thing, the New York markets have that a lot of people don't have, and that's the international flow of money coming in.
Yeah, I was busy with foreign nationals. I would have maybe one a month, two a month. That kind of quieted down. That's very quiet right now.
Yeah.
Money coming in from Asia, money coming in from Europe. That's a little quiet right now. Not saying it's not going on. It will always go on, but it's just quieter than normal.
Yeah, and I think you're going to have that. I think new development is going to be hit hard because you just do nationwide here, Miami, where a lot of new development was being done because people just can't. People don't know exactly what's going on, and we rely so heavily on internationals to come into the marketplace. And right now, people can't travel; they can't fly. So that's the problem. So I think that's going to be an interesting thing. Well, my brother, anything else you want to leave people with?
Yeah, I mean, what's going on when they're applying for a mortgage? Just make sure they get their ducks in a row. Make sure that they have all their documents ready to go. Certain things that are going on for self-employment borrowers. Now there's something called the COVID letter, where self-employment. So if you're self-employed, you own a business, you do your own tax returns. Non-W-2 employee, you have to write a letter that your business hasn't been affected by COVID, or is your business is or isn't, where is your business and how has your business been affected by COVID? So that's something new that Fannie and Freddie is requesting, things of that nature.
So you just think it's going to be definitely more stringent in order to get that loan. And as you stated before, 700 credit score. What was the other thing you mentioned to that?
Well, no, it's a little. Well, I just mentioned what Chase was doing, but across the board, it's just a little bit difficult to get mortgages.
Okay.
Underwriters are really going deeper into files and looking for things. And then another thing that's going on right now is the day of the closing or the day before the closing, we have to call your employer to verify you're employed.
Right.
So what
right.
happened is, yes, I could have started your process beginning of March. You were employed. Now you're ready to close, right? 60 days, figure, at beginning of March, end of April. And now you're
Could be
not.
out of a job.
Right.
Yeah, yeah. Wow, that's something to think about. Also, too, what was my last question to you? I think a lot of people, and like I said, real estate, when you guys are out there, you have to remember, and I always want to caveat this, every market is different. So make sure that you understand every market is totally different based on what is being said here today. New York is a special market. We have co-ops in this market that have a lot of equity in it. So therefore the market doesn't fluctuate as drastically as it would in other parts of the country, because in this market we are 65 to 70% co-op, 35 to 30% condominiums. The condos, people really, I would say of that 25 to 30%, 15 to 20% of those individuals live in those condos. So we're only probably dealing with about 10% of people who, they call it dark apartments, who don't really,
it's going to be, it's for the next, I say in the next 2 quarters, it's going to be, I personally think the summer, it all depends on when our president, and by our president, I mean Cuomo, President Cuomo, because at this point, my only president is Andrew Cuomo.
Exactly.
But but when Cuomo decides that we're opening up, and I believe this summer is going to be interesting. I don't see bars going to be packed the way they are. I don't see New York being the same way. So even if comes the 15th rolls around, everybody's going to jump back on trains, and I'm going to start commuting in. Like it's going to be different. We're just going to be living in a different world.
Right. So like I said, things that will open up. I think people are you're going to still shift. It's going to be so much, depending on industries and what industries survive and stuff like that. And I think things will survive. It's just, I think the commercial market is going to be hit extremely hard, because of just because. Not going to make sense for some businesses to reopen just because it's going to cost more to reopen, and they're not going to have the number of they're not going to have the same traffic that they would normally have because of the social distancing, which then therefore affects the rent. And we all know the rent here in New York. You got to make that note. You got to turn those tables in New York in order to pay that rent. So it's going to be a real interesting 2020.
It really is.
Yeah, it really is. Anybody has any questions for Max that y'all want to shoot me before we wrap it up? Let's see what else is out there to discuss. Are you seeing any loans being made now across the board? Are people still buying?
Yeah, people are buying. I just got a contract. Someone bought something virtually, which is that's very new, right? So they saw it virtually. They're doing everything online. I think that's going to probably be the new norm. People are purchasing. It's not as heavy as it was about 45, 60 days ago. More refinance in this industry right now. So most banks are refinance heavy, where usually it's a good solid 60-40, 60% purchase, 40% refinance. Most banks are probably now 70% refinance, 30% purchase, or maybe even higher, 80% refinance, 20% purchase.
Wow, that's a lot. One question for you, because this is a health issue as well as an economic issue. So we're not 2008, but are there any banks that people should be weary of, or are banks on the verge of collapsing? What's happening around the banks? What's your inside scoop that you can tell people that we need?
So we have to remember, so people are getting mortgages. So when I got my first mortgage, I'm going to give away my age a little bit. When I got my first mortgage, I was at 6.5%.
Wow.
Well, this was 2007. It was 6.5%. So that's only 13 years ago. So 13 years ago, we were at 6.5%. We're at 3%, 3.125. In the ARMs. I mean, if you do an adjustable rate mortgage, you could be in the twos. Obviously,
Wow.
adjustable rate mortgage will adjust after that fixed period. So if you're looking at a 7/1 ARM, it's fixed for 7 years, and then on year 8 and every year after, it will adjust.
Mm-hmm.
That's in the twos. In the jumbo, if you're looking for a jumbo loan, you're in the 2%. You're at 2.8, 2.7, around there. So can banks continue to give? So that's the question you want to ask. Can banks continue to keep giving loans at that low rate?
No, right. I mean, does it make sense for them to do that?
Right. So that's what you have to remember. I mean, yes, the clients are getting a very low rate and their mortgage payment is very low, right? But can banks sustain that?
Right.
How much longer can banks keep giving out mortgages at 3%?
Mm-hmm. Right. And do you see a difference between a smaller bank versus a larger bank with that being the case? Or
smaller banks like credit unions always historically had lower rates than all the bigger banks because they were credit unions.
Mm-hmm.
But again, how if you're a cost of funds, so if you're a credit union and you were borrowing against a certain fund for these mortgages, those cost of funds was 2.7, let's say, and you were giving a rate of a mortgage at 4. All right, so you're making a lot of money on that mortgage from 4 to 2.7.
Right.
But now you're giving a mortgage at 3, and your cost of funds is 2.5 or 2.6 or 2.7. You're not really making that much.
Right.
So you have to start thinking, what's going to happen next, right? So what,
So do you see the big banks? Do you see the government? Do you see them collapsing, or do you see them being able to maintain under this government stimulus package that they keep pumping money into the system?
I mean, I think they will sustain because I think the banks are going to get their bailout.
Mm-hmm. So they're getting that in the fees of by lending the.
Yeah, it's there. It's there. I mean, it is. Listen, it's big government, and they're going to get their piece of the pie. So with that money, they're going to sustain, right? Mm-hmm. The big banks. Small banks, I don't know. I really don't know what's going to happen. But
right.
You go 1 or 2 years at very low rates,
it can become a problem. A couple of questions. How is remodeling loans? Are people doing that? Taking out loans for remodeling? Yeah. Is that that thing? Okay.
There's a couple of banks out there that do them. I think shout out to Citizens. I know a couple of people at Citizens. They do that remodel program. Mm-hmm. So they, I don't know their guidelines on that. Their guidelines might have tightened up on that, okay. So be wary. Okay. But yeah, there's programs out there that you could do a remodel.
Okay. And then do you think that we are in danger of seeing massive foreclosures and defaults on commercial leases and any read on protection to lessen those numbers?
Yes.
Yeah, we already talked about that. Yes.
Charlie, one of the reasons, and I know you told your clients is I use Max because he doesn't lie. Whatever comes out of my mouth is brutal honesty. And yes, we're going to see a lot of it. We're going to see a lot of residential foreclosure. There's people that cannot make their mortgage payments. They legitimately cannot make their mortgage payments. They live check to check, and they cannot make their mortgage payments, and they cannot, so you're going to see foreclosures across the board. I mean, how much will it tick up? What's the percentage? I don't know, but it definitely will tick up.
Right. I mean, I know New York is pretty healthy because a lot of that's the difference between New York and every other. Now the boroughs like Queens, deep Brooklyn, parts of the Bronx, you might face that situation. But Manhattan itself, the close Brooklyn, Long Island City, all of that. And when I say Brooklyn, everything south of and west of Grand Army Plaza. Right. Those are healthy neighborhoods where there's a lot of money in this city, and people don't realize how much money is in this city. Mm-hmm. Let's see. We're closing out. Do you? By the way, I do have a client for you. I'm meeting with her tomorrow, so she's looking to buy. She got a good job with a VC firm. So we'll be working on that, and we'll be working on that other deal that I referred you to earlier this time. So with that being said, I want to thank everybody for tuning in to the first Lunch and Learn by Charlie Lewis. Love the way you live with my boy Max Rosa at Popular Bank. I will have all of his information, of course, in the watch party. You can go back if you just logged on. You can go back to the beginning of this and listen to our conversation. And I'll see you guys next Wednesday at 1 o'clock for the second Lunch and Learn episode. And tonight I'll be on at 8 with John Dunson on my regularly scheduled program. So I just want to say thank you, Max, for coming in and sharing your knowledge and letting us know what's going on. And I appreciate you, my brother. You're always there.
Be good.
All right.
Stay safe, everyone.
All right. Bye.
Bye.